So welcome everybody. Thank you very much for joining Value for Constants and Currencies for our third in a series of 4 discussing foreign Forex risk management. You have with you today in conversation myself, Sharon Constanson, and Eddie Rule. Eddie also works for Best Forex as well as for the Constants and Currencies group as well. So thank you very much for joining us. I appreciate having everyone with us. So thank you very much, Eddie, for joining me. It's always a pleasure to spend time with you. Thank you for being on this with me because we're going to have some fun today. So thanks very much, Eddie.
Thank you.
Just to recap on what we've been doing so far in this series, we've talked about what is Forex risk management, what are the typical actions that people do that we see over and over again that actually create risk and often cost rather than negating or mitigating either. We're also going to look, we have already looked at the areas of Forex where people have misunderstandings. They have belief systems that things are working in a way and have an outcome as expected. And it's just discussing some of those myths because they're not actually what people sometimes perceive them to be. And then we've also looked at the role of the foreign exchange function within an organization that imports or exports. And we've also looked at some case studies. That was what we did in our first session. In our second session, we broke down and looked more at the foreign exchange policy and looking at understanding what exposures are, how does that create a risk within itself, because those exposures are not easy to track. They're constantly changing. The day-to-day aspect of business is also constantly changing. So we covered that in the last session. This session, we're going to look at the different decision points that a company needs to operate on. We're going to look at the different instruments that are available to us. And then we're also going to look at the aspect of dealing that different organizations can engage in and areas where that might create risk to the business as well. So first of all, I'd like to just go through, and I'm going to get Eddie to share some of his experiences in these things, the different decision points that an organization needs to consider when they're in foreign exchange. And I've broken them down just initially, Eddie, into internal benchmarks, different internal exposure factors that might be important. When you look at the benchmarks, we're looking at sort of the static stuff, the accounting rate, sales rate. How often do you find that this drives some of the Forex decision making? Or is it something that's often just ignored completely, or something that the customer doesn't even know exists, that information is important?
Yeah, I think it is ignored, it's used just blindly in a lot of cases. But in a lot of cases, the actual benchmark is not correct because the exposure was not recognized at the right time, or they're just using an internal benchmark rate, which is fine, but that's not going to help you with actually managing your foreign exchange at a profit or a loss. If you're just looking at the internal benchmark, you need to look at the actual rate that you can achieve. Yeah.
I think effectively what that does is puts the business at risk of underselling or overselling the price of its product, understating the gross profit in the business is another risk, and you end up with the P&L sitting in the finance department instead of within the business, losing market share because they're pricing inappropriately, because they have used a financial accounting approach to the costing rates rather than a Forex business approach to getting the rates determined for the business. So those are the kind of things that I have seen many, many times. So we've both had similar experiences where companies often get this rate in certain ways. If I look at one group of companies that I work with, one of the companies in the group takes the cost rate at the country's tax regulators' average rate, which I can never plot how the hell they get to that rate, because it's not a spot, it's not an average, it's not a month end, and it comes out about a week before the month end. Very odd. The other one works on a budget rate or a forecast rate where the whole year is set at a rate that they aim to improve on. Another company I work with actually sets that costing rate at a policy rate, which sits there for years. As long as they beat that, they're happy. So there's very little relevance to the business cycle that Forex is impacting at that point in time. The other aspect that we talked about in a lot of depth last session on policy and appetite. So obviously one of the things that we're doing in foreign exchange activity and making the various decisions is to actually perform against policy requirements or respond to our appetites. So if we look at the internal factors, the actual exposure themselves, you alluded to this a moment ago in terms of when something should become important or on the radar or recognized. Do you want to just talk a little bit more about that in relation to time horizons and the different lead cycles that we're familiar with?
I mean, typically, you get people that are only recognizing an exposure on invoice, but they've ordered the thing a month or two ago, and at the time of order, they actually quoted their customer a rate. So now he's got 2 months that he's lost in premium or rand movement that could move against him, that he has not even looked at all, and waiting for an invoice, which comes 2 months later, and now all of a sudden he wants to recognize this thing as an exposure. It's too late. You may have lost, well, you may be in a position where you're losing a lot of money on it.
Your risk factor is massive, and what I would just call in another language, in a governance language, a blind spot. I mean, it's an absolutely, they just don't see that item. And that is exacerbated by year ends. The year ends, they will revalue debtors and creditors. They don't revalue orders, but they revalue all the forwards. And in a company's case where they are actually covering some of their orders, because that is policy and it is good practice, now finding out that they're revaluing 100% of the one side of the equation and 0% of the other side of the equation, creating an absolute anomaly at year end. Have you come across any other year end types of complexities that arise, or story along the lines we've just spoken?
I think we talked about that last time as well, where people only manage the thing to year end, but your exposures don't stop at year end. It continues for as long as you're in business. And to try and manage the thing to get a certain result at year end is, I think, folly. I mean, you need to look at your exposure and forget about the year end. The year end is just one of those things that you just have to report, but continue to manage your exposure as if there is no year end.
In our next session, we're going to be covering accounting issues, so it'll be interesting to sort of delve into that into a little bit more detail. But we have another example with the customer who has a policy that they have to cover a season. The season is about 8 months out of the 12 months of the year, and the season sort of ends about 2 months before financial year end and starts in a quiet 2 months in the new financial period. And they almost like fall off a cliff of doing nothing at all about managing the ongoing business for that 4 months, which is quite an interesting focus, and one of the things that we've educated them on. Let's talk a bit about competitor environment and customer pricing, the kinds of things that we would want them from a Forex hedging point of view. If they've got hedging, they've got whatever instruments we're going to talk about in a moment, how does that impact what the competitor's activity might be, or how they might price themselves to be competitive?
I think you always need to be aware, firstly, where your competitors are sourcing their product from, and then what that currency that they are going to be paying in and invoiced in, what that currency is doing compared to what the currency that you're invoiced in is doing. Because if your currency starts strengthening and the other one doesn't, then you're going to find yourself in an uncompetitive environment, and you need to do something differently in order to stay or retain market share.
Absolutely, I totally agree with you. And a lot of companies operate in that vacuum of their own business or their own currency and forget there's actually a global world. I was talking to a customer the other day, and the business is taking quite a bit of strain. And the reason being is that the underlying product component of their product has become unfashionable in the Northern Hemisphere, and they in the Southern Hemisphere are now being impacted by that. And yet it's not the customer. It is another unrelated activity that is happening in another country, which is really quite fascinating. And people don't always risk manage that diversity of impact, black swans that come from the other places that we didn't expect. We talked about cover ratios quite a bit last session, so I'm not going to go through that, but obviously that is an internal factor. If we're suddenly very low on cover, it would become a decision impacting point. When we're looking at taking out some hedging, and we'll talk about the instruments in a moment, can you just run through that? Why, when, how much, how long? How does it all link? Just a bit around how would the Treasury Manager be addressing those 5 points?
Yeah, okay, I think the first thing is, what is your exposure? Where, at what levels are you in at? The second thing is, where are we right now in terms of the market trends up and down and so on? And obviously, within the policy, you need to make sure that you're within the policy. If you're not, you have to get into it immediately. It doesn't matter what you have to do and what the levels are. But then what I've always done is I'm looking at where are we right now in terms of the market trends. At these levels, how much movement do I see in my favor and against me? And obviously, you need to get your risk-reward ratios right. If you're seeing movement against you as much bigger as movement in your favor, then better you start taking some cover out, because you're saying to me that you should be hedged. And then what I've always done is I've looked at support and resistance levels on the currencies, and then decided, and this is, I mean, I managed a whole lot of exposures all at the same time. So for each client, I would look and say, at these levels, I would be happy to start buying or selling, whatever the case is. And that's how I manage it. And always at this stage of where we are in the trend, how much cover am I happy with? 50% or 70% or only 30%? And that's how I manage the exposures.
You alluded to something really interesting there, Eddie, is it's not just one decision. You're making constant decisions as the markets are maturing, moving, interest rates are moving, trends are moving, wars are happening. And you're considering the business and the portfolio as an ongoing mix, and you're utilizing, adding new business, adding more cover. And you're not trying to make one decision for the year. You're making in any order 3-4 decisions that you will be picking it up at levels that are going in your favor, always trying not to aim to hit the top, because if we aim to hit it, we won't. And also making sure we don't ever hit the bottom. And that means multiple decisions within a trend. And means you get an average, but your average is usually better than any one of those decisions, unless you're just really damn lucky and you do hit the top, which we've all had those wonderful, it's like getting that one golf shot that you always go back and play golf for when you get that hole in one. It's as infrequent as a blue moon and a hole in one as well. We also see customers that link a specific order to a specific contract and then marry them together for certain periods of time. And that could also be a decision determining factor. I'm not going to get into the decision of whether that's right or wrong. It depends on the company, but it does create a high degree of restriction of the activities that they have in terms of portfolio management. Just looking at the timing of looking at payments and receipts and looking at matching cover, which is what I've just alluded to now. At that moment that funds have come in or an invoice has to be paid, as the treasury manager, what are the things that you're going to consider before you do anything? What are the decision-making factors that you will look at?
Okay, well, the first thing I would look at is, let's say you have to make a payment out. I would have a look at my portfolio and say, what do I want to do with my portfolio right now? Do I want to increase my level of cover, or do I want to decrease my level of cover? Or do I want to leave it the same? If I want to leave it the same, I'm just going to use some of the hedges that I've got in place and pay it away. If I want to increase the level of cover, I'm going to just buy it in at spot and do the payment. So it's not, linking that you just alluded to. I also believe it creates additional risks because you get people canceling some stuff on the one hand, and on the other hand, they want to buy again for a new order. So yeah, I don't like the linking thing. Yeah, getting new exposures and doing a payment, the same processes are followed, and you have to look at the whole exposure. What do I want to do at this point in time? Where are we in the trend? And yeah, do I want to increase or decrease my cover, or leave it the same? And that's really the decisions.
I smile when you talk about somebody cancelling cover in the one hand and then taking new cover with the other hand. I've actually seen a new customer do exactly that in those early days we were getting to work with them. And this is what he wanted to do all the time. And it's been 3, 4, 5 months of learning for them to understand that that actually isn't going to, it's not productive. I mean, you're throwing away the spread all the time. You're creating risk all the time. And change that strategy to creating a bucket, for want of a better word, because they are a matched philosophy. So that is already, as you alluded to, it removes your opportunity management hugely by matching things as matched as this particular company works. But we've created a bucket of unmatched results of contracts. So they've taken $100,000 and they're sitting with 2,000 left. And you'd be amazed how quickly that little bucket has filled up. So when it got to placing another order, they had literally 80% of the order was now already hedged. It's there instead of having cancelled it. And given where the market has gone, they had cover sitting, this is in this particular case, dollar rand. They were sitting now with cover at 14.80.15 instead of taking it out at 15.80.16. And the sort of the light bulb moment was lovely to watch. So the other thing that we notice as a decision-making point is extending cover. A lot of companies, when they're matched, they will extend to the match period. But if you're actually looking at portfolio management, your extension of cover comes back to these why, when, the how long, the linking, the why comes into why you're extending cover and for what period you're going to be extending them for. I want us just to have a quick look at some of the instruments. You would like to just share with us the difference between a vanilla and a forward derivative, a vanilla forward and a derivative forward.
Okay, I think if you understand the derivative forwards, all of them are actually have their basis in the vanilla product. So if your view is just half right, you're going to always do better in the vanilla product than you would in the derivative. So I don't like the derivatives and I don't use them, and I've had plenty of opportunity to use them. I've never used it because I could not find compelling reasons to actually use them. As I said, if your view is, the only reason where I would use an option, for instance, is if I really do not have any clue whatsoever and I want to buy insurance, then an option is good. Other than that, I've not found compelling reasons to buy derivative products.
Yeah. It's interesting. We obviously take on portfolios that have derivative products in them. And derivative products, you're either paying an extra premium or you're losing some of your discount. That's the bottom line. They are expensive
Absolutely.
in comparison to. They offer one, obviously this is a selling point from the authorized dealer or the bank or the broker, is that they're simple. It's one rate for the year or one rate for the quarter or one rate for the month or whatever it is. So that makes your accounting easier at the cost of. So you and I both absolutely agree on why I don't use them either. Why would I take a more expensive instrument when I've got all the flexibility of a vanilla product? Far better to have a rate applicable for a given day, which is the last day of the instrument, and then you use the swap market, and you always get the best of your points. The option instrument you alluded to a moment ago, the problem that I have often seen with an option is how much further the rate would need to go to recoup the collar or the floor or the average rate or whatever kick in or kick out has gone into that structure. You actually literally sometimes have to go cents away, dollars away from the current spot to actually get yourself back to the vanilla price. So often they are extremely expensive, used certainly by exporters more often than importers because of the way they're structured. But still, the opportunity management is very restrictive because you're looking at a day in time. You're not looking at today, tomorrow, the next day. I've got all these days to make these decisions. Now you only got one day, which affects you as well. The other thing that you alluded to insurance. I thought that was an interesting way of describing it. I think the one and only time I've ever suggested to a customer to go for one of the option structures, not necessarily the zero cost collar, which is the most common one used for exporters at the moment, but this was where a company had put in a tender for activity that was really grossly outside of normal business. And if they'd hedged it, and it had not materialized, they would have something grossly different to what they'd ever need in the company. Also, depending on which country you are regulatory wise, you could or could not have done that. So that's the other issue. And if you're then saying for the cost of 10,000 rand, dollars, sterling, euros, whichever it is, or zero, I'm prepared to protect my tender price for the period of my tender. And you take that as exactly the rules you said, that is insurance. So both understand that. When it comes to dealing, how many times in your life have you picked up the phone or got your keyboard and transacted? Share with us the difference between a phone call, the positives, the negatives you feel in a phone call versus utilizing any of the various digital ways of doing it.
I think obviously I prefer the phone call. That's what I grew up with in my early days. People don't even know nowadays what a telex machine is. I used to deal my small swaps on a telex machine. But yeah, I prefer the phone call because
the same
it's just yeah, it's and I mean you're talking to the person and you can get a sense of what's going on. Not that you should take your cues from whoever you're talking to at the bank. You should know what you want to do before you talk to them. So yeah, I think it's quicker. I think what one needs to bear in mind and be very careful about is make sure that you express what you want to do very, very clearly and confirm the transaction and listen to the confirmation coming back from the bank, because if the person on the other side got it wrong and they're confirming the wrong transaction, I've had cases of that where the wrong thing was confirmed, and we had to go with a tape recorder and say, yeah, this is what we confirmed, and you said yes. So you got it wrong. Sorry. So yeah, that's the first choice is, I think, a phone call. Secondly, I would like to. I deal on electronic platforms. I don't like them much, and the simple reason is because there's no consistency over the bank's different platforms. So the one calls it buying, the other one calls it whatever, but they call
Purchasing
it different things.
or
Yeah,
yes,
and yeah, dealing via email, not interested.
no, it doesn't work. I find the biggest risk of a online platform is because you're not speaking and listening, the chances are you'll pick up the error. Also, the person you're speaking to will say that you don't normally do that. Are you sure that's what you want to do? If they're misunderstanding or you have got it the wrong way around. A platform is, it just takes what you give it and it just gives you back. So if you give it rubbish, it gives you rubbish back. And there's no double check, no logic of using a different sense of your senses, because you type it in, you look at it, you see what you thought you put in, not what you did put in. And once you press the go button, there's no discussion. You can't fix it easily. Whereas if the second you've done it with the dealer, you say, ah, I've got it wrong. And they can probably undo it. Back office hasn't matched it yet. They haven't had the dealer take it out in the market yet. There are lots of ways in which the relationship will allow you to fix an error, even after the fact, when you've got to the tape recording and you've proven that the customer is wrong or the bank is wrong, whichever it happens to be. There's a relationship that allows that not necessarily to be a binary 100,000 cost. It might be a shared cost. It might be a different cost, or it might be, why don't we work it through and see if we can undo it? Yeah, the relationship is so critical. And I think that's an important aspect to know. In summary, I would like to just cover the many points that we have to make decisions, the constant interaction and review that we are going through on a Forex basis. So you do need somebody who knows what they're doing, has the time, has the focus to do foreign exchange, because if they're pulled in other directions, Forex comes last. They remember it in their car on the way home or on the bus or the train on their way home. Instruments will behave badly. And if you don't want to behave badly, they will behave badly. If the markets are volatile, the instruments will behave badly. Vanilla instruments give you the most best protection, the most flexibility, the best risk mitigation, and does give you the opportunity management in a far more constructive way. Never assume somebody you talk to knows about your business, knows anything about the market, or has any insights that you couldn't have yourself, because we don't know what the market's doing. It's bigger than all of us. We have to assume people we're talking to are biased either to a product, to their knowledge, to the economist view in their business, or the corporate reference point that they're from, and also be aware of the risk of being able to make mistakes in different platforms that we use. Very quick rush through a foreign exchange day in a treasurer's office, the kind of work that they need to be doing, the kinds of decisions they are making, and why they are coming out with a covered position in a given instrument, and that they are reacting to the markets and the information, and they're doing it in a certain way. So I hope that's given you all some good insight into how this market works. And thank you all very much for their time and effort in being with us. We do have a couple of questions that have come through, but unfortunately we are out of time. So thanks very much for your time and effort. I do appreciate it. Thanks a lot and goodbye.